Hello. Well, this is video number 2. I'm going to talk about the stock market, the equity market, what they call it, and why people should invest in the equity market and why the equity market goes up over time and how I feel that'll always go up over time. Historically, it has always gone up over time. And the reason why it goes up over time is because every day, CEOs and management of companies, they go to work and their job is to run the company to be profitable. Profitable for who? Profitable for the shareholders. Management and CEOs tend to be large shareholders in the company, so it's in their best interest too to increase earnings, which eventually will reflect in the share prices. And people's human behavior is to consume. So as long as we keep consuming and wanting more, the stock market will trend higher over time. Now there will be times when the market goes down. Could be due to earnings, could be due to what's going on in politics, or most of it is, I shouldn't say most of it, but a lot of it's got to do with what's going on in the media. That's one thing you do not want to listen to the media. All they want to do is scare you, And one thing that people have to understand, it doesn't matter who is president. It doesn't matter if it's a Republican or a Democrat. CEOs of companies don't run their business based on who's in office. They do run their business based on what policies the current administrations have going on. So, and I know this might rub some people wrong, but the current administration we have in there now, which I won't mention his name because it inflames people, but they are very pro-business, which should result in higher stock prices over time. Even if you got regulation, which chokes companies, but CEOs and upper management will find ways around regulations to push up the earnings per share, which eventually pushes up the stock prices. And I hear a lot of people say, well, what about a recession? We're going to have a recession. Recession are part of the normal business cycle. We've had them for 100 years. We're going to have them for the next 100 years. And you cannot time the market. Nobody can time the market. You have people that say they can time the market, but there's nobody that is on the Forbes 400 that has made that list by timing the market. It's people that held shares in companies or own businesses outright for a very long period of time. So that's what we're talking about. What I want to do here now, I want to show you the returns of the S&P 500 since 1953. As you can see here, in 1953, the S&P was down 6%. And the next year, it was up 45%. Can you imagine getting 45% return on your money in a year? It's crazy. As you can see, these red lines here. So you had 3 years up. And then in 1957, it was down 14%. 2 years up, and then it was down. You notice every time you have a down year, you tend to have a very good year up. So when you're investing and your stocks are tanking, this is a time to buy right here. Like in 1962, market was down 11%. You want to buy because the following year, you're up 18%. This is where you're building wealth. You're building wealth in these red lines. This is where you really build wealth. Look at here, 1973 and 74, you're down 17%. The following year, you're down another 29%. And when you're young, this is who I'm mostly talking to right now is the young people, is that this is when you're in the accumulation stage. At your age, you're in the accumulation stage, and this is what you want. You want down markets. You want that we get more shares for your dollar. And then you got right after 1974 down year, you got 31%, 19%. And then we can go here, the year, some of you might remember the year 2000. There was 3 bad down years. Okay, see they're down 23% in 2002. In 2003, it was up 26%. Of course, everybody talks about the Great Recession or the financial crisis. 2008, the market was down 38%. And then after that, we had 1, 2, 3, 4, 5, 6 years that are up. And they range from as little as 0% to 23 to up to 29%. So as you can see here, that a lot of the down years you had, the big down years were followed by big up years. Now, do you think that, okay, well, if I have a big up year, it'll be down, so I'll sell at the top? You don't know that, because look at this stretch here. If you would have sold like here, it was up 26%, well, I'm going to sell because I'm going to have a down year, you would have missed out on the next 4 years, which is 14, 2, 12, and 27%. So you can't time the market. It's time in the market. That's what you must understand. It's time in the market. Now what I want to click on to is the dividend aristocrats. And what are dividend aristocrats? They are stocks that have paid a dividend, and they have paid an increased dividend for 25 plus years. And you can see over here the list. I'll go to the top here. The top here, right here, you can see that's Clorox, ExxonMobil, General Dynamic, Hormel Foods. I'll scroll down through these real slow. There's 57, I believe. Kimberly-Clark. A lot of these names you'll recognize, and you might not. But they increase their dividend every year for 25 years straight. And a lot of these companies have paid dividends for 70, 80, even 100 years. They have paid their dividends. Okay, they pay a dividend every year. But these ones have increased the dividend for 25 years. You know, can you imagine getting a raise of 25%? Get a raise for 25 years consistently. And this is through wars. This is through recessions. This is through the 2008 financial crisis. They raised their dividend. This is through the 9/11 attack. You know, look at these companies just keep raising their dividends. This is, like I said, through all kinds of economic disasters and world chaos, and this is why you don't want to listen to the media, because their job is to scare you. Now I'm going to go what they call the dividend kings. Now these stocks here have raised their dividend every year for over 50 years. And right here, American Waterworks has raised their dividend every year. Listen, you get a raise every year for 65 years. Here's Dover for 64 years. Some of these other companies you might recognize is Emerson Electric, 63 years. Procter & Gamble, they make Tide, 63 years. 3M, 61 years. Johnson & Johnson, 57 years. Coca-Cola, 57 years. Lowe's, 57 years. Colgate-Palmolive, 56 years. Hormel Foods, 53 years. Tootsie Roll, 52 years. Look at these companies have raised their dividend every year for over 50 years. And this is why you have to, or you don't have to, but you should be investing in stocks. Because like I said, CEOs and management, it's their job to increase earnings, which result in increasing share price. And how many times have you heard or seen out there and heard out there that where companies have laid off thousands of people? IBM is one of them. IBM is a dividend aristocrat, has raised a dividend for over 25 years. And they've laid off thousands of people. Now, how would you like to be one of the people working for IBM and knowing that they're making money, they raise a dividend to the shareholder. The shareholder is always going to get, or always has made more money through IBM. So that's why you have to own stocks. If you're not owning stocks, you're just working, and you really are not going to get anywhere financially. You have to own stocks. You have to own a diversified portfolio. Now, I don't recommend, for a majority of the people, 99.9% of the people do not buy individual stocks. But through mutual funds, target date funds, and like I said, I'll do another video on that at a later date. Because I think it's just too much takes too much time out of your life to do that unless you really enjoy it. Now what we're going to do, we're going to look at a portfolio visualizer, and this is it takes different classes of stocks over the years and what they've done. And what I want to show you here is that the one of the worst 10-year periods was from 1999 to year 2009. As you see here, I put that in the start year, the end year. Initial amount is $10,000. And then down here, one of the benchmark, we're going to use the S&P, Vanguard S&P 500 index fund. And a lot of you heard of Vanguard. I know you have. And then, but the asset class is U.S. stock market. We're having 100% U.S. stock market, which is, I don't know exactly. It's around 3,000 stocks in there. In our portfolio 2, right here, we're going to have 25% in U.S. stock market. We're going to have 25% in U.S. mid cap. We're going to have 25% in U.S. small cap, and then we're going to have 25% international developed ex-U.S. market. International developed are the international markets that are developed. Sometimes you'll hear about emerging markets. Them are the real small markets that are not really developed. This would be like Europe, mostly Europe, like Britain, Spain, Italy. And then the third portfolio would be just cash. So this will just show you what if you just put your money in CDs. Actually, what I want to do here, I'm going to change this. It's at 10,000. I'm going to change it to 6,000. And the reason why I say 6,000 is that what you can put in a Roth IRA. So we're going to pretend we have this in a Roth IRA. So we have $6,000 in a Roth IRA. And I'll go down here and push on this Analyzer portfolio. And then here's our pie charts. Our first portfolio, remember it was 100% U.S. large cap. Here's our portfolio, our second portfolio, which is divided up in quarters with U.S. large cap, U.S. mid cap, U.S. small cap, and international developed. And like the third portfolio will just be plain cash, like CDs at a bank. You can see where portfolio 1 down here, my cursor at, the 6,000 is worth $7,000. Didn't gain much for 10 years. You average 1.71%, so that didn't do so well. And then you got portfolio 2, which is the diversified, the 4-quarter small cap, international in there, mid cap. That did 10,000. That's all right. That did 4.86. And then portfolio 3, the 6,000 is worth 8,266, average 2.96. These are not great returns, but I told you, like this is one of the worst 10-year period. And here's the S&P 500. This is Vanguard 500 index. It didn't even do 1%. Actually, cash beat the Vanguard 500 index. I know a lot of people talk about Vanguard, S&P 500 index, and I do myself have some of that in my portfolios, but it's not one you want to have all your money into. Okay, so and I wanted to show you this. This is the worst 10-year example. So it shows you that you can barely make any money. Now what we're going to do, we're going to start out. We're going to start out with, we're going to add another 10 years. So 1999, now we're going to go all the way to 2019. So now we're talking about a 20-year period. Between 1999 and 2009 was the worst 10-year period. Now we're going to look at a 20-year period, a $6,000 investment, not it. Okay, so we're going to come down here now. The $6,000 in portfolio 1 turned to $25,000, average 7%. Portfolio 2, which is a more diversified portfolio, is worth $30,000. It averaged 8%. And portfolio 3, which was cash, earned 1.81%. And the Vanguard 500 index investor, 6,000 went to 23,000. So you see what the index fund has done. picked up some steam. And you can see, and you can run the cursor over here, like in May 31st, 2009, it shows you the different values of Portfolio 1, Portfolio 2, Portfolio 3, and the Vanguard. And see how the Portfolio 3, which is cash, see it's at 8,000, and then the Vanguard was down to 4. So you think, well, that's a loser. But if you hang on to it, look at the difference. Now you're looking at 21, or if you go all the way to the end, 23,000. So you don't want to sell here. If your portfolio's down and you're thinking, I put 6,000 in it, and Portfolio 1 is down, you don't want to do that. Let me try to get this on here a little bit better. So you can see Portfolio 1 and Vanguard both are underwater. What they mean underwater is that below your initial investment. But if you hang out, write it out, and this is when you're accumulating. Actually, when you're accumulating stock, you want down markets. This is where you're going to make your most money. I know it's funny. Well, I'm losing money. No, you're not losing money because you're setting yourself up for the return, and you're buying a lot of cheap. The stock market is like an auction house. When you most people know that you want to buy stuff when nobody else wants to own it. That's where you make money. So now we're going to say, I want to talk about how impressive it can be long-term investing. What we're going to do here, we're going to go back to 1979. Okay. 1979 to now is 40 years. We're going to say that you got $6,000 in a Roth IRA. This is 40 years. So this is your 20-year-olds. Let's say you don't have $6,000. I know some people say, I don't have $6,000. Let's say you have $2,000. You started in an IRA. We're going to say a Roth IRA. Roth IRA, gross tax-free, federal and state. In the state of Iowa, it's free anyway. Okay. We're going to contribute fixed amount. We're going to say we're going to put in $500 a month. And I know lots say $500 a month. How do you do it? Let's say if you make $30,000 a year, that's 20%. Would be $6,000. If you work a lot of places you work, they'll match you 5%. So basically, you need to put in 15%, and the company will give you the other 5%. And inflation adjustment, we're not going to increase the dollar amount by inflation. So you're going to put in $6,000 a year for the next 40 years. You're not going to increase it, even though you make more money. You can increase it, but we're saying you're not just going to put $6,000 away a year, or $500 a month. I'll change this to monthly. Okay, we will have to. No, we can keep Vanguard on there. Reason why I was saying that because Vanguard goes back to 1976. Thought maybe they're analyze portfolio. And it says up here, the time period was constrained by the availability of data for the international developed ex-U.S. market. So they go back to 86. So what I'm going to do here, I am going to take the international development out. We're going to replace that with small cap value. Small cap value has done very well over the last 40 years. So now Portfolio 2 is going to have U.S. stock market, U.S. mid cap, U.S. small cap, and U.S. small cap value. And you can get all these classes of stock, with asset classes, through ETFs, which stands for Exchange Traded Funds. I know I don't want to get too deep in the woods on some of this terminology, but we're going to analyze the portfolio. Oh, well, look at here. Putting $2,000, started with $2,000 initial balance, and you're going to put $6,000 away a year. In 40 years, you're looking at $3,944,000. The more diversified portfolio is $5,400,000. Cash, you'd have $495,000 cash, and the S&P Vanguard, you'd have $4 million. See, so you 20-year-olds, you can be multimillionaires. That's only starting out with what, $2,000? You only start with $2,000. You put $500 a month in. I know that might seem like a stretch, but you can do it. If anything, you could, have your parents would help you out. Wouldn't that be a gift? Your parents give you $1,000 or, $500 to help you a little bit. You can, and you don't have to be the $6,000 a year if you can't afford it. But I find that hard to believe that you couldn't afford $5,000, especially if you're living at home. There's no excuse if you're living at home you can't save that kind of money. But look at that. That's starting out with $2,000, $6,000 a year. You can be a multi-millionaire. And then if you put this in a Roth, it's all tax-free. So you can be a multi-millionaire. So let's look at here. Move this over here. So let's just say you did the Vanguard. So you have 4,144,728. And you drew 4%. That means you drew 4% off to get, that gives you $165,000 a year of tax-free money. Imagine that. What could you do with $165,000 tax-free? And your money's still going to grow. That's just, it's crazy. Like I said, you young people, you're sitting on a gold mine. You don't even know it. I know you don't know unless someone tells you. Well, I'm telling you now. You're sitting on a gold mine. And these numbers that I show here, imagine if you increased. Let's not do it that way. Let's just do it this way, because let's say some say, I can't afford $500. Let's drop that down to $300 a month. Okay? Should be able to do $300 if you get a 5% match from your company. You're still talking $3 million, $2 million, $2.5 million. You're still talking about with Vanguard. Okay? But you want to diversify. You pick up, have less risk, asset class risk, than if you stay diversified. But let's go back up here, and let's say you're able to put in $600, $100 more. No, we're going to keep it. I'm sorry. We're going to keep it at $500 a month. But let's say you happen to have $4,000. You start out $4,000 instead of $6,000. See what we get here. Did that look right? Yeah, 2,000 more, 500. So you're almost at 6,000. 4 million, 4 million, 1, 4 million, 3. Let's put that to 6,000. Look at that. Then you finally go over $6 million. 4 million. Portfolio 1 right here. 4 million. Portfolio 2. Here's your cash. Here's your CDs. Someone wants to play it safe. I don't want to take no risk. I don't want to lose no money. Guaranteed. This here, the cash. Guaranteed you won't lose money. You will not lose money. See? Right here. This is the yellow line here. That's your cash. Never went down. It never went down. It steady went up. Now look at these here. Let's take this year right here. In 2000, you had $1.2 million in Portfolio 1. Well, let's take the Vanguard. You had $1,300,000. Okay. Then let's see. Okay, in 2002, okay, you're down to $836,000. You lost about $500,000. You lost $500,000. How is that going to make you feel? Well, if you use history as your guide and you don't panic, you're going to be all right. You're buying here again. Okay? But you're still well above cash. Okay, so here we go again. 2007, you were at $1,500,000. And then comes the financial crisis. The world's coming to an end. Okay? You're down. You've lost about 650,000. You're down. But I want you to look at portfolio 3, that's your cash, that's your CDs, that's the guy that's playing safe. I'm not going to lose money. Guaranteed you will not lose money. That's right. But you lost to inflation. That's what you lost to. So you got $425,000. If you have a more diversified portfolio 2, you're still at $1 million. On the Vanguard, you lost $600,000, but you're way above cash. You're way above cash. So what I'm trying to say here, we'll go all the way to the end, and here at the end you're at 4 million, 5 million, 4 million again, 500,000 in cash. I don't know what else to tell, try to convince people. But like what I want to tell you here, we'll go back to this historical. I'm trying to figure 1973, 74. That's when the oil we were going to run out of oil. That's another thing. In the 90s, I've been investing for 32 years. In the 90s, it was peak oil. We were going to run out of oil, and it was this big panic. We're going to run out of oil. We're going to run out of oil. Well, that's the media will do that to you. It's crisis, just like with the Iran thing. We're going to war. We're going to war. Okay, these are serious things that are happening around the world. But listen, people, CEOs and management, they get up every morning, and they're not going to say, well, we bombed Iraq, or this is going on, or I'm not going to work today because of that. No, they're going to work, and they still have to generate earnings, generate income for the company. Just like you, whatever goes on in the world, you still have to get up, and you still have to go to work to put food on the table. And look, even the financial crisis, you still have to go to work. A lot of people lost their jobs. Okay, and look, this is what I say. People lost their jobs, and it took them years and years to recoup. But look what happened the next year with stock investors, up 23%, up 12%. Now we can go back. We'll use this back test and see. We'll just do this here. I like this back testing. We'll go to 2008. Change this to 10,000. Everybody uses the word 10, or not word, but the number 10,000. No contribution. We'll keep the same asset allocation. So cash was 10,000. 10 years later, after let's see. Yeah, look at that. We're in 2000, December 31st, 2000. We're starting with 10,000. We went down to 5,000. We lost half the value. See this here? You just put the money in. Let's say you put $10,000 in of January 31st. Okay. Actually, got to back it up a little bit. Or 10,000. February 28th, you were down. You lost half the value, unless you had cash. But you were safe. See, you have 10,000. You got 10,100. So you say, look, I didn't lose no money. There's guys, I didn't lose no money. I didn't have no money in the market. And you're looking at yourself and you say, shit, I lost half the value of my investments. Was it 11 years later? Am I thinking right? No, I'm sorry. Yeah, 11 years later. 11 years later, look what you're at now. But look at the guy, the portfolio 3, the guy with cash, the guy that he's got 10,000. Now, there'll be people out there that'll say, well, I got in there. I'll guarantee you when that was going on, I shouldn't say nobody. The guy that thinks he can time the market is going to tell you he got in there. And I don't believe it. A lot of people that started investing here, they've done tremendously well. They thought, geez, this is easy money. The market's easy money. But we will have a time like this sometime where the market will take a big hit. And if you got 40 to 60 years of investment horizon, you will have probably at least 2 to 3 major pullbacks of 30-40%. But you're going to have to realize that as long as people keep consuming, human nature is to consume. Human nature is to always want to do better. It's in our DNA. So until people quit consuming, or when people quit wanting, that's the big thing. Everybody wants. Want. Well, what you want to do, you want to be the person that the money's going into your pocket. Companies' jobs are to take money out of your pocket and put it in their pocket. So you're going to want to own stock in the companies that are doing that. What you first want to do, you first want to become an investor and then a consumer. If you can get that, if you can, most people start out right away in their early 20s, they're consumers, they're not investors. They don't become investors until they're in their 40s or 50s, start thinking about retirement. That's when they really start thinking about investing seriously. You take investing seriously when you're young, and you will reap the benefits. You will reap the benefits. Well, this concludes my video on why a person should be investing stocks of all ages, but especially the young ones. That's really taking advantage of time. Time's an asset. I tell people time's an asset. When you're young, you have a huge amount of time, so you have a large amount of asset. I don't have that much of an asset left, But that's all I have to say for now. In the next video, I will talk about what, not particular funds, but like in your 401ks or IRAs, what are the best options for majority of the people. And that will be like the target date funds, and I'll explain how the target date funds work. So until we meet again, stay positive. Thank you.